Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. For years, investing in private real estate has been a very popular alternative investing strategy as it provides portfolio diversification and income. However, COVID brought new worries to parts of the private real estate market while we're now amidst of an interest rate cutting cycle. So, what does all this mean to private real estate sector? Well, I have on the perfect guest to help answer those questions. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am very honored and really excited to welcome Brent Jenkins. Brent is the managing director and portfolio manager at Clarion Partners. Brent, thank you so much for coming on the show. It's an honor to have you on. Can you please tell us a little bit more about yourself and Clarion Partners?
Absolutely. First of all, thanks, Ryan, for having me. It's great to be here. So in terms of background, I'll start quick on personal background. I live here in New York and work in the New York metro area. I'm married with 3 wonderful teenagers, 2 dogs, and commuting into the city most days when I'm not traveling, which I travel a lot. So, but in terms of professional background, I've been working in the industry for 30 years. Actually, coming this December, it will be 30 years. And I was thinking back, about when I came out of college. Like a lot of college kids, I didn't know what I wanted to do, but I found myself just kind of falling into real estate somewhat randomly, and ended up loving it. I started out in property management and operations, really learning this business from the ground up. And then after a number of years, I made my way over into the investment side of the business, in a number of roles, investing both debt and equity across the risk spectrum, from real estate development oriented strategies all the way to core plus type strategies like the one that I work on today. And over my career, I've held positions focused in the US and also in the international markets as well. And that's led to where I am today, which is sitting here as a portfolio manager of our Clarion Partners Real Estate Income Fund here at Clarion in New York. So a little bit about Clarion. We are one of the largest pure play real estate focused investment managers in the U.S. We've been in business for a little over 40 years. We have about 75 billion in assets under management today. We've grown over time to now have about 350 employees spread across 10 offices here in the US and in Europe, headquartered in New York. Now, interestingly, Clarion, so we are majority owned by Franklin Templeton as of 2020. Okay. With Clarion employees that actually own the balance of the firm. And that's really important point actually here, because that employee ownership really drives our culture. Something that's really important as an investor, something that really matters, and I think in something that really drives an ownership mentality that ultimately benefits our investors. So within Franklin, the firm is one of several specialty investment managers that we call SIMs within Franklin that comprise roughly 250 billion in assets under management. That would be the alternative investment platform at Franklin Templeton. So Clarion, being the real estate specialist within those SIMs, we invest across both equity and in debt in numerous real estate sectors, including industrial warehouse and rental housing, various alternative investment sectors. And we have given our history, have a really deep expertise, and we're actually a first mover in some of those sectors, like industrial warehouse. And in fact, we are one of the largest owner, operator, investors in industrial warehouse properties in the US.
Okay.
And then today, just if you take a step back, our portfolio, it consists of around 1,500 properties. One thing I will say, over the 40 years, we've been focused as a firm as investing on behalf of large institutional clients.
Hmm.
However, in the mid 2000 teens, we opened up the Clarion platform to individual investors through a couple of different investment initiatives. And this includes the Clarion Partners Real Estate Income Fund, which we commonly refer to internally as CP-REX, which is one of the tickers for one of the shares, but opened it up to the individual investor through these initiatives. And so CP-REX focuses on a couple of different goals, just to give you kind of a sense of my perch and my vantage point in the market. One goal is to create long-term capital appreciation, but equally, it's to create steady, durable income over the long term. So if folks want to learn more, we obviously, Clarion has a website, cprex.com is a website, but that's just a little bit about me, the firm, and kind of where I sit within the firm.
Fantastic, Brent. Thank you so much. And I will include that information in the show notes on where they can get, our listeners can get more information. But I love your story about starting with their boots on the ground. I think that just gives you so much more experience. I love it when people, nobody's really going to start at the CEO level. I mean, I don't think,
Okay,
but
great.
being able to start, whether, I often heard stories. I lived in Seattle for a while, that people at Starbucks, before whether you're a director or in headquarters, you had to spend time as a barista, right, to understand what they're going through. And I think it just gives you so much more expertise and experience as you move up that chain of command. So that's fantastic. I love it.
Yeah, and I think, and it's interesting because I think as a firm, Clarion, part of the deep expertise that we have as a firm as well is not only as an investor, but as a firm that owns and operates, properties as well. And so, that type of experience for many of those within the firm, it's not only just a personal thing, but also applies to the firm as well.
And you only, there's only, you can gain so much experience by working with your boots on the ground, right? And it just helps with that expertise across the board, whether you're a portfolio manager of an equity fund, or whether you start as a trader or something like that. In this industry, you can learn so much. I mentioned at the beginning about COVID. It kind of rocked the, and you talked more about industrial space, but maybe the corporate space. And one thing I've realized in this I've had a lot of conversations about alternatives and real estate, is I don't think people realize how big real estate is in all the different sectors and subsectors of real estate. You've talked about, like I said, industrials. Now there's data centers and all this other stuff. Can you give us your thoughts on private real estate since COVID, and how is the health of it, and has it changed?
Sure. So I think a good place to start is just what role real estate can play within a portfolio. And a dedicated allocation to private real estate in particular can really help improve just risk-adjusted returns associated with a traditional investment portfolio. So the traditional 60/40 stock, bond portfolio, in that real estate provides good, strong income. From a diversification standpoint, diversification benefit standpoint, it has really low correlation to the public markets. And it's a great inflation hedge. And that's why you see, when you look at institutional investors and what they're, how they invest, they maintain this kind of an illiquidity sleeve that includes alternative investments, like real estate, so that they can capture all of those benefits. So I think that's, kind of as a grounding, important to say. Um, Second is just from a timing standpoint. I mean, we think it's a really good time to be an investor in private real estate. When I say private real estate, I mean both investing in equity, so that means actually going and buying actual buildings or participating in the ownership, direct ownership of buildings, and then also in debt. So as a direct lender, so being a non-bank lender in effect to others. Um, on the equity side, from a timing standpoint, over the last 18 months, since interest rates went way up, we really saw a reset of value. And so investing today, or if you own real estate, it's going to be we think it's a great opportunity now to capture both strong income, as well as long-term capital appreciation as values recover over time. At the same time, on the debt side, there's good opportunities as well to make loans to others, given that, we're in a higher interest rate, environment. So having, if you have the ability to pivot over and make debt investments, it's a great income strategy. Now, to understand why, you have to look at the backdrop, and going back over the last 5 years, it's been super interesting. 2020 had the pandemic. 2021, we had uber low interest rates. I called the unicorn year, when just deal volume was through the roof, right? We had the term transitory inflation at the time, which now had turned into real inflation and almost chronic inflation. The response was a rapid rise in rates.
Yeah.
And then layer onto that, in kind of the spring of 2023, we had a regional banking crisis, which I mentioned just because for real estate, it had a particularly acute effect, in that regional banks were big construction lenders, had become big construction lenders in the real estate space. So we're heavily participating in 2021, for example, when rates were low and developers were starting a lot of new projects. So what was interesting, though, over the last few years, right, is how quickly rates went up and how high they went up. So, it took two cohorts really kind of by surprise in a lot of cases. One, folks that ended up taking on a lot of leverage in 2021, super easy to do. Rates were low. It was very tempting. It ended up acting as adding a lot of risk, to a portfolio, to the extent that that you did it. It was something for the fund that we manage, that I manage, something that we really manage down and try to keep low leverage, given the conservative strategy. Something else is others that maybe were in more challenged sectors, such as office, which is always the elephant in the room, right? When you're talking real estate, it's a sector that operationally has seen some really rough times with higher rates, and has structural issues where it's really hard to define what the demand for office is like, and that's going to take a long time to sort out.
Okay.
So those two sectors affected, and then obviously real estate values, as I said, ended up taking a bit of a hit, right? But that's where it gets interesting, because every cycle is different.
Mm-hmm.
We didn't have a recession this time. It was a capital markets dislocation. So while we had a reset of values, if you take office and put it aside, right, real estate overall operationally has performed pretty well.
Yeah.
Certainly areas that had kind of macro global tailwinds, driving them, like housing or industrial warehouse, have operationally done pretty well, assuming that you were able to maintain your leverage, right? The low leverage. So, even in 2023, that then provided, in that higher interest rate environment, while, buying a property in a market where you're seeing values come down, that strategy became really tough, because, it was a real rifle shot, versus kind of a shotgun blast in terms of strategy. There were good buys, but they are few and far between. However, being a lender in 2023, to the extent that you were well capitalized, that was great, because the risk-adjusted returns were pretty high. And So for like our fund, 75% of the new investments that we made in 2023 were actually loans to others. So that kind of brings us to where we are today. Real estate values have reset. Real estate operational performance is good. Deliveries of new buildings, right? So the supply of real estate is actually starting to dwindle because if you think about it, higher interest rates,
Okay.
difficult to develop, along with inflation, makes it very costly to build a building. And the economy, so supply is under control. At the same time, because we didn't see a recession, the economy remains strong, right? And so driving demand. So on a go-forward basis, to the extent that you are an owner of real estate or that you're able to buy real estate in a market like this, right? What's the outlet when you have strong demand and limited supply? In real estate, it's rents. So, our expectation is in the well-performing asset classes that are thematically driven, right? That you'll be able to capture higher rents due to that supply-demand equation, which then ultimately translates into value. The unique thing about right now is that not only is equity investing, so buying buildings, right, going to be something that pays off, but also that debt trade, right? That pivot over into debt, and that as an option to invest in the market through debt still exists because we have that higher interest rate environment, especially in real estate where you had a section of, a portion of the supply of loans really kind of going away with shrinking of the market with the regional that was filled by the regional banks.
Wow, Brent, that was fantastic. And I love how you started out just taking a step back and talking about portfolio construction. That's at our heart here at Zephyr is, building optimized portfolios. I've done a bunch of studies on, including real estate, moving that efficient frontier to the Northwest, right? Optimized portfolio, increase return per unit of risk. The other thing I want to touch on, you mentioned transitory. We haven't heard transitory in years, so I think there's a drinking game to transitory. So this is just coffee, but
I'll take a sip of water to that.
there we go. And then lastly, I'm really glad you brought up, interest rates, inflation, and there was, and you brought up the difference between equity and debt, and with interest rates at 2-decade highs, that lend to perform better with debt, right? Lending and so on. Are we in an inflection point? Interest rates are coming down. We're in an interest rate cutting cycle. Inflation is coming down. Do you think within this private real estate cycle, maybe we're at an inflection point because of the macro dynamics behind it?
Yeah, I think the signs we've started to see positive signs, within the starting early 2024. And that has come in the form of a number of a combination of a number of macroeconomic indicators, as well as capital market indicators as well, that are, we think, tilting towards that inflection point. And is especially in this case important in terms of real estate and being a real estate investor and it being a capital markets dislocation to really pay attention to those capital markets indicators as well, specifically in addition to those macroeconomic economic indicators.
Fantastic. And we talk about trends, we're in a falling interest rate environment. And, I would like to think we're getting back to normal in terms of after COVID, we're normalizing, interest rates are normalizing. Are there any other trends you see in the private real estate space going on right now?
Yeah, so I can address that in a number of different ways. I think one way to address it is just looking long term over multiple cycles, right? And how do you approach real estate investment knowing that there's always going to be these economic cycles, whether it be capital markets dislocation or a recession? And with that, I mean, especially given that Clarion, for the most part, is a core and core plus investor. So we're investing in mainly stabilized type type properties, really looking long term and as a long term investor. And I'd say the same thing is true for the fund that I manage in particular, looking for that long term capital appreciation and long term steady income. It's important to look at long term trends. And so we have at Clarion, for example, we have a dedicated 12-person research team that all of our portfolio managers work with to really help identify, the big global trends, understand what they are, understand how specifically they impact the real estate that we're investing in. And so those 5 trends, for example, would be things like demographics. What are the big, what are the big cohorts that are moving through the age continuum, and what are the characteristics associated with those core cohorts? So for like millennials, household formation coming into big income earning years, it's a different set of characteristics associated with baby boomers, for example, another big cohort. Second is housing, right? So, what's going on with housing? And there's 2 things that come to mind. One is housing shortage, and it's not just for sale housing. While we may be overall 3 million rooftops short, right, in terms of supply, that's split between for sale as well as rental housing. Especially given that there's an affordability issue associated with housing. Third would be innovation and technology. I think the way that a lot of people relate to that is through Amazon, and other e-commerce, in that you've seen how e-commerce has become a larger and larger share of retail channels. So for real estate in particular, retail has there's a subsector of retail real estate that has been cannibalized, right, and transformed into supply chain, i.e. industrial warehouses. And so you've seen a big boom there. The fourth is trade and manufacturing. You've seen a lot of onshoring just in North America in general, a lot of manufacturing moving to Mexico, a lot of manufacturing moving to the US. If you live, for example, in a suburb of Austin called Taylor, Texas, that they're building a big chip factory there that's going to employ 2,500 people in a town that has a population of 2,500 today. So, a lot of big changes coming, and there are ways, right, obviously, to leverage that through real estate markets. And then the last is resiliency, which there's a lot of aspects to it, but a lot of people think of it in terms of most recent, which the hurricanes and insurance costs and things like that, which obviously drive pro formas and performance. So from a trending standpoint, I mean, we tend to look, very long term.
I love those trends. I'm really glad you brought those up and listed them because they're fascinating. And it's not, real estate's one, but just in general in the wealth management space, it's impacting a lot of things. And like you said, just the retail markets living up in Lake Tahoe, there's not a whole, we are going to get a Target here within the next year, and that's huge news. There's not much up here, and we have to rely on Amazon. But just to let you know, Amazon Prime up here is like 3 days, 4 days. So
that will be changing for sure.
Yes, exactly. You know, it, the evolution of alternatives have really changed. And, when I was a portfolio manager, we always included REITs, but it was always, like a limited partnership but the access points, getting access to real estate has really changed. Now, a lot of, like you said, the product that you manage is now in the form, you could just enter a ticker, right? A mutual fund. It's easy to access. What are some different access points to private real estate now that, it's becoming more accessible to the everyday investor?
For sure, yeah. And I think, there's differences between, as you alluded to, between public real estate and private real estate. So when I think of public real estate, I think of, as you said, public REITs. Now, the issue there, right, as from kind of our vantage on the private side, when you do a comparison, is that investing in public REITs, yeah, you're investing in real estate kind of indirectly. You're really investing in a company, right, that invests in real estate. It's publicly traded, so on exchanges, which means that on a daily basis, you're subjecting yourself to, as an investor, right, to the volatility associated with the market. So there's a lot of market correlation, that's there, and they end up kind of trading somewhat like small cap stocks.
Okay.
Versus from an access point, you also have, I'll call it the larger non-traded REIT space that provides investors the ability to invest more directly in real estate itself. They're called NAV REITs for a reason. It's like because their price basically fluctuates with the actual private value, of that real estate. So they take a number of forms. The more traditional, non-traded REITs. You also have interval funds in that space. You have tender funds in that space. CP Rex, for example, is a tender fund. So you can purchase, as you said, through a ticker on a daily basis, and they all offer up quarterly liquidity. But with them, you really get better access to the benefit of adding real estate to a portfolio, in terms of, they have strong income like the public side, but they come with a lot less volatility. So they really can act as a better contributor to that movement of, as you said, of the efficient frontier up and to the left, which is to say, allowing a portfolio to access really better risk-adjusted returns over the long term. I think, and that's key, because I think it's important to look at real estate, right, as it's a long-term investment.
I'm glad you brought that up real quickly. Any considerations? You brought that up, the different access points, different ways to gain access to real estate, plus being long-term. Any other tips that you can provide financial advisors when they're looking to include real estate into a portfolio?
Yeah, I think it's also to look at the composition of the various portfolios, right, within funds.
Mm-hmm.
One of the things that really helped us a lot over the last few years, just given all of the volatility in the market itself, was to have access, right, two different access points to the real estate market itself as a fund, right? So not just like having the ability to buy buildings or participate in the ownership, but also having the ability to, in the flexibility to pivot over to making debt investments as well. So to the extent, for example, you managed a fund or a strategy, right, that had the ability just to buy buildings in 2023, right, we saw declining values and transactions volumes falling pretty heavily, good 60, 70%, right? But to the extent that you had the ability to pivot over into the debt space, it was a great income pivot over into income. But if you think about it, you're able to participate in a much more cushioned portion of the capital stack in a falling value environment. And because at the time, really achieve returns commensurate with what you had prior seen on the equity side of the investment spectrum.
Brent, that was a fantastic way of ending this conversation. I love it. You shared so much great insight. I enjoyed the conversation. I know I learned a lot. It's a real estate people, I think, understand the value of including private real estate to a portfolio, but there's a lot of other dynamics. It's such a wide space that, it's great information you provided to help our listeners create better investment decisions and better portfolios. Thank you, Brent, so much for coming on the show. Real quickly,
Thanks,
where
Ryan.
can our audience get more information about Clarion Partners?
So we do have a website. All you have to do is Google Clarion Partners, probably the easiest way to do it. And then with respect to the fund that I work on as a PM, cprex.com, which takes you to the alternative section of the Franklin Templeton website.
Awesome. Thank you so much, Brent. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all previous episodes on the Zephyr YouTube page. And lastly, please give Zephyr a follow on LinkedIn and like and subscribe the Zephyr YouTube page. Thank you very much and have a great rest of your week.